Hello everyone, we are from NBTM2A BA 262. We'll be presenting our assignment on financial ratio analysis of logistic company in Malaysia. First of all, we would like to impress our heartfelt thanks to our lecturer Dr. Mohamed Faizal Basri, who has taught us financial management and continually provided the knowledge and support to complete this assignment. Now, I would like to introduce the team members who has worked together on this assignment. I am Nur Izzaty, followed by Nur Ayu Sorfina, then Nur Izzaty, next is Noor Shaziela, and finally Mohamed Auris. Next, Izzaty will continue by presenting the table of content.
And I will provide a brief overview of financial ratio for company in the logistic industry. Here is the list of content we will cover in this presentation. We begin with an introduction and company background, then the 5 ratio category of financial ratio, followed by a cross-company comparison, key recommendation, and lastly is conclusion. Study focus on the financial performance of 5 logistic companies: TASCO Berhad, GDEX Berhad, Post Malaysia Berhad, FM Global Logistic Berhad, and Tiong Berhad. Using their 2022 to 2024 financial report, it's compared 5 key ratio category: liquidity, leverage, efficiency, profitability, and market metric to assess each company's strength and weaknesses. The goal is to identify which company maintain the most stable financial ratio and provide recommendation for improvement.
I will share a brief background of the companies we have chosen. The first one is Post Malaysia, or is widely known as Post Laju. It has been around for more than 200 years and it has reached more than 11 million addresses across Malaysia. The second one is FM Global Logistic, was listed on Bursa in 2005 and has grown into a Malaysian-owned international logistic company with a network of more than 127 countries offering air, sea and land transport. The third one is GDEX, listed on Bursa Malaysia in 1997, specializes in domestic and Asian express nationwide, and it offers real-time parcel tracking and strategic partnerships with other companies to expand their company. And the fourth one is TASCO, incorporated in 1974. The company runs 25 logistics centers nationwide and has 6 divisions, span air and ocean freight. The last company is Tiong, listed in 1992. The company is an asset-based logistic provider across Malaysia, Singapore, Thailand, Vietnam, Laos, and China. Tiong has more than 3,000 employees and it has more than 2,000 vans and trucks. They have been in the industry for more than 45 years. We will next talk about the types of ratios that we used on these 5 companies to complete this report. But first, it is important for us to know what is financial ratio. Financial ratio is a tool that is used by banks, managements, and even investors to help these people to measure the company's strength, weaknesses, and trends. Because different company has different figures, different company has different sizes. By using these ratios, we can benchmark whether a company performance is better than other companies while being in the same industry. In this presentation, we will cover 5 types of financial ratios, which is liquidity ratios, leverage ratios, activity ratios, and profitability ratios and market ratios.
Liquidity ratio is defined as used to determine a company's ability to pay short-term debts. Shows where the company can handle the bills and expenses in future. If the ratio is above 1.0 times, means the company is in a strong position. Liquidity ratio is divided by 2 types, which is current ratio and quick ratio. First, current ratio. Current ratio, it shows if a company has enough assets like cash, stock and money owed by customer to pay its short-term debts. It also helps to understand company's short-term financial health. The current ratio calculated as current asset divided by current liability. Second is quick ratio. Quick ratio shows if a company can pay their short-term debts using only its most liquid asset like cash and receivable without selling the inventory. The calculation is current asset minus inventory minus prepayment divided by current liabilities. This chart is a current ratio and quick ratio overview between 5 companies for the year of 2022 until 2024. Current ratio on the left chart shows FM Global Logistic and GDEX has a strong liquidity and better position than others. And the right chart shows FM Global and TASCO had strong quick ratio in 2024, which is above 2.0 times, showing they can pay short-term debt with cash and receivable, and steady growth for GDEX for improving liquidity. Also, a warning sign for Post Malaysia and Tiong due the quick ratio is below 1.0 times, shows possible short-term cash issue.
Leverage ratio measure how a company use debt compared to its own capital and how well it can manage debt repayment. The debt to equity ratio show the balance between borrow fund and shareholder. Equity higher ratio suggests a greater financial risk, while lower ratio more conservative and stable financing. The time interest or TIE ratio, calculated by dividing EBIT by interest expenses, show how easily a company can pay its interest costs. A higher tie means a stronger ability to meet debt obligation, while a lower tie may signal potential cash flow issues. These two ratios help evaluate a company's financial stability and its ability to handle debt under different market. This slide highlight how each company managed its debt and interest obligation over the past 3 years. First, FM Global Logistic consistently maintain low financial risk with stable debt level and strong interest coverage throughout the period. Secondly, GDEX Berhad show improvement in leverage, indicating a shift to a more balanced financing. TASCO Berhad experienced a notable increase in debt, reflecting aggressive funded by borrowings. Tiong Logistic carry high and rising debt level, which could pose a risk if earning decline. Lastly, Post Malaysia gradually reduced its debt but still operate above the conservative. Next, I will talk in time interest earning overview. This section compare how well each company could cover its interest expenses using operating profit. FM Global consistently recorded strong interest coverage, indicating solid earnings strength relative to each debt obligation. GDEX maintains stable and healthy coverage with minor changes in its debt level. TASCO show that its increasing debt remain manageable due to sufficing operating profit. Tiong expressed weak and less stable coverage, which may rise concern if profitability continue to fluctuate. Post Malaysia recorded low interest coverage, suggesting that significant portion of its earning is consumed by interest payment. Overall, FM Global and GDEX demonstrate more conservative financing strategy and stronger capacity to service debt. In contrast, TASCO and Tiong rely more heavily on borrowing. The differences in tie reflect level of financial strength and stability across the companies.
This slide breaks down the two key activities that reveal how efficiently a logistic company turns its resources into revenue. First, the average collection period (ASAP) is calculated as account receivable divided by daily sales. It tells you, on average, how many days elapsed from the moment a shipment is delivered until the cash actually hits the bank. A shorter SAP, for example 30 days instead of 50, means the firm is collecting its receivable more quickly, which reduces reliance on external financing and free up working capital for reinvestment or debt servicing. Second, the total asset turnover TAT ratio is simply sales divided by total asset. It measures how many ringgits of revenue each ringgit of asset produced in a given year. A TAT of 1.8 times, for example, indicated that every 1 ringgit of property, plant and equipment generate 1 ringgit and 80 cents in sales. High turnover company, those above the 1.5 times industry median, are making the most of their warehouse, flats and IT system and squeezing more sales out of each asset. By presenting these two metrics side by side, this slide shows both the speed of company cash conversion cycle SAP and the productivity of its asset-based TAT. Together, they pinpoint which firm excel at converting asset and receivable into cash and revenue, and which still have room to tighten collection or redeploy underused asset for better return. This slide shows each company, SAP and TAT from 2022 through 2034, revealing both cash conversion speed and asset productivity. FM Global Logistic leads on receivable management, cutting its SAP from about 140 days in 2022 to 120 days in 2023, and further turn around 100 days in 2034. TASCO Berhad follow closely, improving from roughly 130 days to 90 days over the same period through stricter credit terms and digital invoicing. GDEX also made progress, reducing its SAP from 100 days to 80 days, while Tiong and Post Malaysia continue to lag, remaining near 120 days to 140 days despite slight improvements. Shorter collection period means faster cash inflow and lower working capital requirement. By combining SAP and TAT, the slide makes clear that TASCO and FM Global set the standard in both cash conversion speed and asset productivity.
Okay, next is profitability ratio. This slide focuses on two important profitability ratio. First, operating profit margin. How much profit a company keeps after covering its operating costs. In logistics, anything above 12% is considered very strong. Second, return on asset, ROE, which measure how efficiently a company uses its total assets to generate net profit. In 2024, TASCO stood out with an impressive 18% margin and strong ROE to cost control and automation. FM Global also performed well, maintaining solid margins and high asset efficiency. Tiong and GDEX show signs of recovery after making operational improvements. Meanwhile, Post Malaysia still struggle with losses and underutilized assets. Together, these two ratios helps us to identify which companies manage both their costs and resources effectively. Okay, next is profitability ratio. This slide focuses on two important profitability ratio. First, operating profit margin. How much profit a company keeps after covering its operating costs. In logistics, anything above 12% is considered very strong. Second, return on asset, ROE, which measure how efficiently a company uses its total assets to generate net profit. In 2024, TASCO stood out with an impressive 18% margin and strong ROE to cost control and automation. FM Global also performed well, maintaining solid margins and high asset efficiency. Tiong and GDEX show signs of recovery after making operational improvements. Meanwhile, Post Malaysia still struggle with losses and underutilized assets. Together, these two ratios helps us to identify which companies manage both their costs and resources effectively.
What is market ratio? Market ratio is a tool to measure how investors value a certain company. And in this part, we chose dividend payout ratio and price to earnings ratio. Dividend payout ratio is a percentage of net profit distributed to shareholders as dividends rather than being reinvested into the business. Higher dividend payout ratio means that the shareholders gets more, and lower dividend payout ratio means that shareholders get less dividends. And the next one is price to earnings ratio, used to measure how much investors are willing to pay for a company's profit. So for example, if this business is making 1 ringgit in profit, how much am I paying for it? So if investors are willing to pay 10 ringgit for a 1 ringgit profit, that shows that the stock is valuable. So this ratio is used to assess whether the stock is overvalued, undervalued, or fairly valued. Both of these ratios are used to measure how much the investors value the company, and the higher the ratio means that the higher the confidence of the investors for the company's future. In this slide, it shows how investor sentiment toward dividends and earnings has evolved for each firm from 2022 until 2024. From what we can see, FM Global Logistic returned 40 to 50% consistently. This shows balance between rewarding investors while also retaining capital. And the next one is TASCO Berhad, maintain to give 35% to 45% range. And GDEX Berhad did not pay dividends in 2022 due to losses, but as it returned to profit in 2023, it distributed about 50% before moderating to 30% in 2024 to fund fleet upgrades. And Tiong Logistic paid no dividends in 2022 and 2023, but in 2024, the company suddenly paid out 60%. This shows the company went through a successful restructuring during 2022 and 2023 and now can reward their investors. And the last one, Post Malaysia has not declared dividends for all 3 years and their ratios fluctuate wildly. This shows that Post Malaysia maybe isn't making enough profit or is struggling with cash and isn't in a strong position to reward its shareholders. The next one is PE ratio, where we can see from the graph, FM Global ratio went from 12 times in 2022 to as high as 18 times in 2023, showing that investors were impressed by the company's improving profit margins. And in 2024, the PE settled at 14 times, which is still solid. And TASCO's PE stayed strong between 16 to 20 times throughout the period. This shows that investors had high hopes for the company's future, especially because it was investing in automation for their system. GDEX in 2022 was making a loss, so its PE was negative, meaning the company wasn't profitable. But it turned things around where its PE went up to 8 times in 2023 and 10 times in 2024, a sign that earnings were improving and investors were starting to trust the company again. Tiong had no earnings in 2022 and 2023, and there was no real PE ratio to report for 2022 and 2023. But its PE jumped to 22 times, which shows that investors were suddenly very optimistic, likely because the company was finally making a comeback after restructuring. And the last one is Post Malaysia's PE was either missing or all over the place, which is a red flag for investors. This tells us that the company is still struggling to make steady profits and investors remain unsure about its future until things become more stable. Overall, FM Global and TASCO enjoy the most stable and attractive market valuations, combining reliable dividends with premium earnings multiples. GDEX and Tiong demonstrate how a return to profitability can quickly rebuild investors' confidence, while Post Malaysia erratic or absent payout and PE ratios underscore its ongoing need to restore earnings credibility before markets will fully reward its share.
This slide brings together all 5 logistic firms in a single composite view with a donut chart showing their overall scores. FM Global Logistic and TASCO Berhad each command 28.6% of the composite score, emerging as clear industry benchmark. Both maintain the current and quick ratio well above 1.5 times for strong short-term buffers. Asset turnover above 1.5 times and average collection period under 100 days for operational efficiency and operating margins north of 10 with ROA above 8%, along with a consistent 35 to 45% dividend payout and mid-term PE multipliers, markers of both reliable earning and investor trust. Tiong Logistic, GDEX Berhad and Post Malaysia each hold 14.3% of the composite. Tiong has built momentum with margin climbing from 2 to 8% and ROA rising from 0 to 5%, but its higher DE above 2 times and SAP near 120 days underscore the need to reduce debt and improve asset deployment to sustain its turnaround. GDEX recovered from 2023 losses to achieve break-even margin and positive ROA in 2024. Post Malaysia lags on almost every front. Liquidity ratio under 1.0 times, DE around 1.1 times with interest coverage under 3 times, sustained negative margin and ROA and an undefined or single-digit PE, highlighting the urgent need for network optimization, asset divestment, or fresh capital to restore liquidity and rebuild investor confidence.
Okay, now we move on to key recommendations. Here are suggested strategies for each company. For FM Global, should continue strong financial management while expanding automation and exploring new markets like cold chain logistics. For TASCO, it's encouraged to scale up automation and introduce more value-added service to support its growth. For Tiong should optimize its capital structure and make better use of its assets to sustain its turnaround. GDEX needs to focus on cost efficiency, strengthen digital platforms, and improve last-mile delivery services. For post-Malaysia requires a complete transformation, like cut down underperforming operations, invest in automation, and explore strategic partnerships. These actions are tailored to improve profitability and long-term growth for each company.
Financial performance summary for 5 logistic companies. We group the companies into 3 categories based on their financial performance. First, the leader. The leader is FM Global Logistic and TASCO Berhad, both showing strong financial health with high current and quick ratios above 1.5 times, low debt level and high interest coverage. They are also efficient in operation and strong profit, also steady in dividend and investor trust. Then the mid-tier is Tiong Logistic and GDEX Berhad. Tiong improved its profit and ROA but still has high debt and unstable liquidity. They need to reduce debts and use assets better. GDEX showing positive ROA and better cash collection. They need to control costs and invest in digital upgrades to grow further. And the last one, the laggard, is Post Malaysia Berhad. They have weak liquidity, which is ratio near or below 1.0 times. They have negative profit and ROA also still struggling with outdated networks and low investor confidence. They need major change like automation, branch restructuring, and partnership to stay competitive. And last but not least, the conclusion for this analysis, FM Global and TASCO set a strong example for the logistic industry. Other firms must take smart action like managing debts, cutting costs, or going digital to stay financially healthy and grow.